Cash is losing value every single second you hold it. Everyone knows that. Economists know it. Your bank knows it. Even the guy on TikTok yelling about index funds knows it. So why would anyone sit on a pile of cash right now, earning nothing, while the market climbs? That's not a rhetorical question. It's the question. And by the end of this, I want you to try to answer it, because I've looked for the flaw in this decision for months. I haven't found one yet. Let's start with the number that should bother you more than it does. Since 2020, the money supply in the United States expanded by trillions of dollars in a matter of months. Not years, months. The kind of expansion that used to take a decade happened in the time it takes to renew a passport. And the textbook answer to what happens when you print that much money fast is simple. Prices rise and cash buys less. That part of the story everyone already believes. It's the part after that people skip. Because right now, in 2026, we are being told the opposite lesson. We're being told that cash is dead weight. That the smart move, the only move, is to put every spare dollar into stocks, real estate, crypto, anything that moves. Sitting still is treated like a financial sin. And I want to ask a very unfashionable question. What if that advice was true 5 years ago and isn't true anymore? Here's the setup. Right now, markets are near record highs. Valuations, by almost every historical measure, are stretched. The S&P 500 has spent most of the last 3 years trading at a price relative to earnings that has historically preceded either a plateau or a correction. Not always, not on a schedule, but often enough that ignoring it isn't caution, it's denial. Meanwhile, interest rates, after the fastest hiking cycle in 4 decades, gave cash something it hadn't had in almost 15 years: a yield. For the first time since before the financial crisis of 2008, you could put money in a boring, insured, liquid account and actually get paid for it. Not enough to get rich, but enough to stop losing, in real terms, while you wait. So here's the actual tension of this video, not cash versus stocks like some Reddit argument. The real question is this: is holding cash right now a mistake, or is it the only rational response to a market that has stopped pricing in risk? Let's break down how the system actually works, because most people invest without ever understanding the machine they're standing inside of. When you buy a stock, you're not really buying a company, you're buying a claim on that company's future earnings, discounted back to today. The math behind that discount depends on one thing more than any other: interest rates. When rates are near zero, future earnings look almost as valuable as cash in hand today, because money is basically free. That's why from 2009 to 2021, virtually every asset class went up together. Stocks, real estate, art, even memes with a picture of a dog. It wasn't 12 different investment geniuses being right at once. It was one interest rate, near zero, inflating everything it touched. Then rates went up. Fast. And the math flipped. Future earnings became worth less today. Because now money isn't free anymore, it costs something to borrow it. In theory, asset prices should have adjusted downward to reflect that. Some did. Bonds got crushed in 2022, growth stocks got cut in half. But something strange happened after that. The market shrugged the higher rates off and kept climbing anyway. And that's the part almost nobody explains clearly. So let's slow down here, because this is the whole engine of the argument. The market didn't keep rising because the math changed. It kept rising because expectations changed. Investors decided that rate cuts were coming, that inflation was basically handled, that the economy would land softly, and they started pricing in that future today, before it happened, before it was confirmed, before anyone actually knew. That's the uncomfortable mechanism at the center of modern markets. Prices aren't really reacting to the economy. They're reacting to a story about the economy that millions of people have collectively agreed to believe, updated in real time, priced in advance of the facts, which is fine, until the story is wrong. Here's the math nobody wants to say out loud in a 15-second clip. For the market to justify current valuations, corporate earnings need to keep growing at a pace close to what we saw during the era of free money. Except, the era of free money is over. Companies are now borrowing at real rates for the first time in over a decade. Debt that used to cost almost nothing to service now eats into margins, and yet the prices being paid for these companies assume none of that friction exists. That's not a conspiracy. It's not even necessarily wrong. Markets can stay ahead of reality for a long time, but it does mean that a huge share of current stock prices are built on a bet, not a fact. A bet that earnings growth, disinflation, and rate cuts all arrive on schedule, in the right order, without any of the usual accidents that history is absolutely littered with. Now here's where hype and reality start to pull apart. The hype says, don't try to time the market. Time in the market beats timing the market. Dollar cost average, and you'll be fine long term. And historically, that advice has an excellent track record. I'm not here to tell you it's wrong. I'm here to tell you it's incomplete. Because that advice was built, tested, and popularized during a 40-year period of falling interest rates. From the early 1980s until 2021, rates went down almost in a straight line, with a few bumps. Falling rates are rocket fuel for asset prices. Of course, buying and holding worked. You were investing inside a tailwind that lasted longer than most people's entire working careers. We don't know yet if that era is over or just paused. Nobody does. Anyone who tells you with total confidence which one it is, in either direction, is selling you something. A course, a newsletter, a version of themselves that needs to sound certain to keep your attention. Here's the quiet irony in all of this. The people most aggressively telling you to invest everything right now are, disproportionately, the people who make money whether you win or lose. Brokerages earn fees on your trades. Fund managers earn a percentage of assets under management, regardless of performance. Financial influencers earn from clicks, and invest now, don't wait, is a much better hook than, actually, maybe wait. Nobody built a following screaming, "Have you considered doing nothing?" That doesn't make them wrong, but it should make you suspicious of how conveniently their incentives line up with their advice. So where does cash actually fit into this? Not as a permanent decision, not as fear dressed up as strategy, as a position, a real, deliberate financial position, the same as being in stocks or bonds or real estate. Cash, sitting in a high-yield account right now, earns you a real return above inflation, something that was basically impossible for most of the last 15 years. It gives you optionality. If markets correct, and valuations reset to levels that make more sense relative to earnings, you're not watching from the sidelines with nothing to deploy. You're the person holding dry powder while everyone else is holding assets they bought at the top, hoping the story keeps being true a little longer. And if the story does keep being true, if earnings keep growing, rates keep falling, and the market keeps climbing, you didn't lose everything. You lost a bit of upside. That's the actual size of the risk people are so afraid of. Not catastrophe, underperformance, which is a very different thing, dressed up to feel a lot scarier than it is. Let's zoom out, because this isn't really a story about cash versus stocks. It's a story about how confident an entire financial culture has become in outcomes that were never guaranteed. We've built retirement systems, media narratives, and personal identities around the idea that markets always go up eventually, so any period of caution is just wasted time. And historically, in the United States, that pattern has mostly held. Mostly. There have been stretches, though, where it took markets over a decade to recover to a previous peak in real terms, adjusted for inflation. The late 1960s into the late 1970s is one of those stretches. Japan, starting in 1989, still hasn't fully recovered to its old peak, in some measures more than 3 decades later. Nobody is saying that's what's happening now. I'm saying the belief that it can't happen here, that this time is structurally different, is exactly the belief every overconfident market has held right before it wasn't. Here's the bigger implication, and it's the one that should actually keep you thinking after this video ends. We are living through an experiment in real time. Central banks pumped in an unprecedented amount of money, pulled back the fastest they ever have, and the market is currently betting that the landing will be smooth, orderly, and mostly painless. That bet might be right. Markets have been right before, plenty of times, when the crowd of skeptics thought they were being reckless. But a bet is still a bet. And right now, an enormous number of people are making that bet without realizing it's even a choice. They think they're just investing, the neutral, responsible, grown-up thing to do. They're not wrong to invest. But they are, whether they know it or not, taking a very specific position on how the next few years unfold. Cash is a position too. It's just the one nobody's currently rewarding with applause. So here's the question I promised you at the start. Not an answer. A question because I still don't have a clean answer either, and I'd be lying if I pretended I did.